Thanks for joining us. We are talking about forecasting layer 2 innovation. I'm Stephan. I thought I'd just give the panelists an opportunity to take a minute and just introduce yourselves. So starting with you, Paul.
Yeah, thanks. My name is Paul, and I work on two layer 2 projects. One is called Drive Chain, which lets you send Bitcoin to other pieces of software and back without any trusted intermediaries. And so it kind of makes all altcoin tech a part of Bitcoin, which is very exciting. But most of the altcoin tech is irredeemably useless, of course. So I'm also working on a different piece of software that used to be called Truthcoin, is now called Bitcoin Hivemind, that lets people trade financial derivatives with each other. So that's a very interesting project, and so you should go to drivechain.info to learn about the former and bitcoinhivemind.com to learn more about the latter.
Hi, good afternoon. My name is Alyse, Killeen, and I work in venture capital with a focus on Bitcoin and the economy that's developing on top of Bitcoin blockchain infrastructure. I have been doing this sort of work with a focus on Bitcoin since about 2013. And now within the field, what I'm most excited about are the higher layers of infrastructure that are developing atop of Bitcoin blockchain and the applications and companies that can be built on top of that and leveraging those advancements.
Hi, everybody. I'm Bhatia. I work in the traditional finance industry as a trader of interest rate products and do interest rate strategy as well. Last year, I wrote an article called The Time Value of Bitcoin. It's about how we can use the Lightning Network to derive Bitcoin native interest rates, and an idea called the Lightning Network reference rate, how we can potentially average rates from different nodes across the network to derive some sort of baseline rate for Bitcoin.
Excellent, thank you. So look, I would like to start with you, Alyse. I think, Alyse, you had a great appearance recently on Bloomberg, and you were essentially providing some insight into how our view of Bitcoin has changed over time. So many, back in, say, 2013 and so on, had a very payments-focused view of Bitcoin. How has that changed and evolved over time?
So one of the interesting things about this space is that much of what we've newly learned about Bitcoin in 14, 15, 2016, or the years since were actually things that were discussed and debated in the cypherpunk chat rooms. And so we had access to a lot of the things that we learned in these past few years. For instance, the fact that Bitcoin core protocol was not going to be something used for small payments or for a large volume of payments, and that we would anticipate to see higher layer infrastructure develop that would provide that for us. And so I think what we've learned in the past several years, we've learned through experimentation, and we often like to learn that way versus in a more academic sense. But what's been important about the pain of the learning through experience, I think, is that there's been sort of a community learning and an advancement of how we think about the collaborative or cooperative process in the Bitcoin ecosystem, given the fact that we're not centralized and don't have a formal traditional governance structure.
Excellent. Paul, did you have anything to add to that in terms of the changing view of Bitcoin, potentially also viewing it in some ways as a settlement layer as opposed to the direct payments layer? Or what's your view?
Well, yeah, I think this new idea, the idea of layer 2 is a kind of new idea that says that, you can still have things that some people wanted on layer 1, you just need to have them in a slightly different way, and it just takes a little bit of cleverness, but actually you can kind of have your cake and eat it too. You can have layer 1 be sort of small block size settlement, and then you can have payments in upper layer. And you can change the upper layers around if you're willing to just find a clever way to do it and sort of have a different security model maybe. So I think that's in general what it used to be just about Bitcoin is totally set in stone, and then it was kind of, we went through an era where there were more improvements, but then now it's kind of the protocol, layer 1 protocol is sort of ossifying, and now it's moving to layer 2. People are doing ton of exciting stuff on layer 2. And so that's the major change, I think.
Fantastic. So Nick, let's throw one question to you. So we are talking a lot about this idea of using Lightning Network, and we are trying to take transactions directly off of Bitcoin's blockchain, and obviously Lightning Network is one way to help do this, and that's from the technical point of view, right? But then when, for example, if I spend a UTXO and I open a Lightning channel with you, Nick, it's not just a technical component there, there's an economic cost. So can you outline some of your thoughts there on how should we conceive of that economic cost? Because it's not free for me to just lock up that UTXO.
Right. Well, before we analyze the economic cost, let's think about Bitcoin, the base layer, as our digital gold. And we can think about, the way I think about how slow and expensive it is to use the Bitcoin blockchain, you can think about putting gold bricks on ships in olden days and moving that across oceans as really this final settlement and arduous process of moving money from one corner of the world to the other. That's the proof of work that goes into securing our transactions on the base layer. The second layer, Lightning Network, we can think of this gold becoming like paper gold, where all of a sudden the velocity of the money can exponentially increase. Because every time you spend your Bitcoin, you don't have to put it on that ship and send it across an ocean. It can just be, instant digital. So that's the difference that I like to think about when thinking about the base layer versus the second layer. It's a money velocity issue, and it's a money velocity solution that we're getting here on the Lightning Network. Then, as far as how can we look at the economic cost, if you're going to use the Lightning Network, you have to open channels using your own Bitcoin. So I like to say that Lightning Network is an app where you need real Bitcoin to play. And once you have that Bitcoin in your Lightning node or in your channels, it is technically locked up by HTLCs, these time lock contracts that we have in Lightning Network. So that time lock is your economic cost. How long do you want to stake Bitcoin to these channels, keep it in there? If you are going to do that, that Bitcoin cannot be used for anything else because you have committed transactions to the blockchain. Even though they haven't settled yet necessarily, you're still signing that and you're committing it. So that is your economic cost. It's the time lock that you're putting on your Bitcoin where you can't spend it elsewhere.
Sure. And I think, Alyse, it might be also interesting just to ask you as well how you're thinking about it with that changing view. How does that drive the way you invest?
Sure. So to follow up a bit on what Nick just said, is that it's exciting to see a continuing financialization of the space. And so as we see ideas around how Bitcoin can be differently used, valued, advanced through additional layers of infrastructure, then we also start to see opportunities for companies to come in and take advantage of those new innovations and the maturation of the broader ecosystem. So, for instance, when looking at the financialization of the broader ecosystem, we're looking at things on the venture side, like custody solutions or security mechanisms, opportunities to transmit payments in an efficient way. And some of Nick's work actually has been really valuable in advancing our thinking and thesis around how Lightning Network advances the space in that way.
Fantastic. Paul, might just give you an opportunity now as well to perhaps you want to expand a little bit on drive chains and that as another model for achieving other functions rather than directly on Bitcoin.
Right. It doesn't really focus on payments, but I would suggest that, there's a few, as I said, a kind of, everything involving the blockchain, I think, is inherently sort of financial, where you'd have to pay for something. You'd pay for hard drive space or for registering a name or something like that. But I do think that if you go through the list of altcoins that aren't totally irredeemably bad, that some people out there actually use. I do think you could indict maybe the large block, but I'm not sure that you could convict it. So it's like you could have some people out there who do want to use a version of Bitcoin with a larger block size, and you could, one of the easiest sidechains or layer 2 drive chains to make would be to just have one that's exactly like Bitcoin Core, but with a larger block size, and that would have different economic trade-offs, but you would be able to use it more in the way that BCH is using their blockchain today, and that would be great for a lot of reasons. One of them was mentioned is that with Lightning, there's a kind of inherent need for the fee to be percentage-based, percentage of the value traded, and that it just opens a little bit of room for payment sidechain to maybe be cheaper in a few cases. A second difference is that with Lightning, you need a layer 1 transaction to open the channel and onboard people to Lightning. But with a payment sidechain, you could just have one very rich person put a ton of, in a single layer 1 transaction, put a ton of BTC over into the sidechain and then onboard people over there on a different piece of software. And so in that sense, it's also, it may be better in a few cases. Lightning is better where the people are, if you need to settle very quickly, 2 people are both online, if they both have phones and they scan QR codes. There's nothing, that's super fast. The sidechain, I think, would actually be slower to settle, but it'd be easier because the recipient of the funds wouldn't need to be online or wouldn't need to do anything. So there are these trade-offs, and I think they're very interesting. But the bottom line, I do think, is that Bitcoin is going to just figure out how to do everything. It's already made a huge amount of progress. So I think a layperson in the audience should just sit back and relax, I guess.
That's right. I want to come back to you, Nick. I'm really fascinated about this whole economic cost of capital concept, and you have touched on this idea of the risk spectrum, and that there might be different returns or ways to conceive of Bitcoin, right? You've got the cold storage, and you've got the different levels of return that you may get. Do you want to touch on that a little bit for the audience?
Sure. So the risk spectrum that we're talking about here is Bitcoin native, right? So you're thinking only in terms of a BTC denomination. You're not thinking in any home currency. Bitcoin's the home currency. So in that risk spectrum, cold storage Bitcoin would be considered the risk-free asset, right? As long as the correct OPSEC measures have been taken, that Bitcoin that you hold yourself is risk-free. It also has no return potential. And if you factor in storage costs, your rate of return is actually negative in theory, right? Because you're not earning anything from it, and you actually have to pay for the storage mechanisms. Lightning Network and routing activity gives this unique next level of risk where you're not taking counterparty risk because you're not signing away your Bitcoin to somebody else, but you are keeping it in a hot wallet environment. You do have the technical expertise required to run a Lightning node currently. Hopefully that gets easier through time, and it will. And it is, by the way, getting a lot easier in the, barely over 1 year that the Lightning Network has been active. You, for the first time in financial history, in my opinion, have the opportunity to earn income without actually taking counterparty risk. You're taking this unique hot wallet channel management risk, but you're not taking explicit counterparty default risk. Going on from there, we're going to now talk about lending Bitcoin, meaning you're actually signing a transaction, sending away your Bitcoin. You don't have it anymore. You have 100% exposure to your counterparty, and only if they decide to repay you, plus your interest, will you get the return of capital. And that's basically how normal, traditional capital markets work. So this idea of the Lightning Network being somewhere in between is a very exciting concept, even though what we've understood from some of the experts out there running Lightning nodes, the ability to generate material fees is just not there. right? The rate of return is going to be outweighed by possibly just your electricity and bandwidth costs, the few Satoshis that you're earning through routing. So right now, it's not exciting from a business model perspective, but from a financial theory perspective, the fact that this is non-zero is very exciting to me.
Fantastic. We're thinking in terms of Bitcoin native financial systems. And I think, Alyse, you might have some great commentary here as well around this idea of building a Bitcoin economy. Can you touch on some of the different players and what's your view of that?
Sure. So I think something that we're experiencing now, which is quite exciting, is to see an entirely new economy be built on top of Bitcoin blockchain infrastructure. So what I mean by that exactly is that today we're seeing the new eBays or the new Amazons be launched, and a new economy will be created by those today nascent companies, similarly to how eBay and Amazon did the same. And those are companies that launched just in the mid-1990s. So growth can happen quite quickly. On the venture side, what I'm expecting to see from startup innovation is, quite frankly, a surprise in what we find in the next 5 to 10 years. So what tends to happen is that there's a feedback loop between infrastructure development and innovation, and then application development and growth that happens on top of that infrastructure. We saw that in the way the World Wide Web developed and applications built on top of the internet developed, so that in 10 years, when we're looking back, we would have never been able to project or anticipate the type of growth or scale or application that the companies being founded today will have. So a quick example of that is that in 1995, only 4% of Americans got their news online once a week. And today, probably most of us in this room have checked the news on our phone already multiple times. That would have been something hard for anyone to anticipate in 1995. And so as we see this new economy emerge on Bitcoin blockchain, leveraging not just the blockchain itself, but the ancillary infrastructure or higher layer infrastructure like side chains or Lightning Network, we'll see, I think, a robustness in applications develop, and that will drive further infrastructure development as well.
Excellent. Paul, do you want to expand a little bit for us on this idea of hive mind and event derivatives and how that may shape our world?
Yeah, I'd be happy to. That's my primary motivation. I wrote that piece of software, and I wanted to connect it to Bitcoin, but there was no clear way of doing it at the time, other than what Blockstream had suggested in 2014, which is this idea of the sidechain, or it was really late 2013. And so I just wrote this as a kind of separate piece of software, and that is what motivated. There was nothing else around when I had finished, so I had to then turn my attention to drive chains. So I've actually wrote them in kind of a different order. And HiveMind is a piece of software for determining what events have happened in the real world without a trusted intermediary, but for letting people trade on those and bet against each other with market assets based on real world events. So it kind of can replicate any form of insurance or any form of, I call these event derivatives. So they're popularly called prediction markets today, and the original impetus for going down that road was a very ambitious idea called futarchy, where you make these assets that co-vary with politicians' expected competence. So you have someone who's waiting in line to vote, and today almost no one votes, and almost no one knows why. They remember a sound bite, or they vote on party lines or something. But with this, you could just be waiting in line to vote, and you could check some prices the same way you would check the price of Apple stock or the price of a refrigerator or something, and you could just see, well, if I vote for this person, this is probably what the government will spend, and this is how much money people in the country will earn, and this is what the unemployment rate will be, and then versus another person. And so it kind of transforms the current paradigm where it's mostly based on ignorance, and you just sort of show up, and most people don't vote, most people don't know their representative's name, and it's just kind of, people just wing it, and that's how we make some of our most important decisions in society. But this is we change it to such a more rational a paradigm. So I'm kind of building a sort of tower where if everything in the tower works, I'll look like a huge genius, but if anything in the tower doesn't work, then nothing will happen. But it's sort of like a drive chain would be the lowest part, and then side chains, and then peer-to-peer Oracle, and then prediction markets, and a futarchy would be kind of at the top. That's like the tower that I'm building. So
great. All right, so look, we're just about to run out of time, but I think my last question for each of the panelists will be, so imagine 5 years from now, it's Bitcoin 2024, and we all met up again. Do you have any bold predictions? Let's start with you, Nick.
I think that Bitcoin is right in between this stage of being a reserve asset and a reserve currency. I don't think that Bitcoin right now is used as a reserve currency because it doesn't have a capital market on top of it yet in any material way. So I'm looking for that transition where we're talking about, in the future, governments and central banks and banking institutions becoming big hodlers. That fact that they'll have that on their balance sheet on the asset side will allow more capital market activity to happen in the future. So I'm looking to see enormous hodlers emerge over the next 5 years.
Excellent. Alyse?
So I've talked a bit about what I expect to see in 5 years, which is expecting to see what we cannot expect or project today. So instead, I will say what I hope to see in 5 years, and that's that we're talking about applications and use cases of the technology that has a broad applicability to folks across socioeconomic statuses and geographies, so that we are working on things that benefit not just those of us in the room, but folks that are less advantaged or living in quite different environments.
Paul?
Okay, so like a bold prediction is something that's supposed to be kind of edgy, I guess. So
Sure.
I guess I would say something. I think probably the most corrupt politicians in the United States will start to own Bitcoin and use it nefariously and use it to secretly send money to. I think that's what I think, and I think it's already probably happening a lot. So I think that's the bold prediction. They won't. People will kind of flip. It's like joining the zombie team or something. They'll flip. They'll be like against Bitcoin, but then they'll learn more about it and they'll be like, wait a minute. And then a couple days later, they'll be like pro Bitcoin, but kind of quiet about it. That's my bold prediction, I guess.
Excellent. Very bullish. I love it.
Yeah.
All right. Are there any questions from the audience? No? I think we've got no questions from the audience, so I think that's going to do it for us. So thanks very much.
Thank you.